Welcome back to International Finance. I am Andy Kim. Last video we saw how the triangular arbitrage works, right? You may wonder, well, that's fantastic. You just have to identify those discrepancy and then find out who is doing this, underpriced transactions they are offering, right? Where's the hole, the black hole, or like a, but okay, what will happen? Those arbitrage opportunities, right, will disappear because you are not alone in identifying those opportunities, and then people will say, baby, one more time, and then they will do it like more and more and more transaction going that way, and then the CA kind of bankers, even though they, initially made some mistakes doing it, but they will find out, oh, I was wrong, and then they will correct it. So those opportunities will quickly disappear, right? No arbitrage, and then there's no free lunch in the market, they say. Anyway, spot foreign exchange microstructure. Then what do you mean by microstructure? It's about the small micro scale buy and sell order processing kind of bid-ask spread. Okay, the way I understand about microstructure is the understanding of bid-ask spread. Okay, bid price and ask price, right? Bid-ask spread. How to understand it? Well, market microstructure refers to the mechanics of how a marketplace operates. The bid-ask spread in the spot FX market. Of course, you can think about microstructure in stock market, which is a huge area studied by Professor 안희준 교수님 or 백영훈 교수님 in our school. Professor An is our dean, the dean, yes. And then he's also the president of 증권학회, the most prestigious finance association, scholars association in Korea. So microstructure, high frequency trading, all these kind of things are studied over there. Anyway, bid-ask spread. Of course, you can think about the bid-ask spread of what is it? Bitcoin. Yes, the cryptocurrencies. Well, the spread, right, in the FX spot market is a function of inventory cost and information. In the previous lecture, I told you about this. It's about the market makers or the dealers, right? Who is dealing in this kind of currencies or commodities. Well, you can think about the bid-ask spread in oil and then crude oil market and then gold market. They will have to keep the inventory. And the inventory naturally brings you the risk, price risk of this inventory. What if that inventory value plunges down abruptly, right? So the dealers or the market makers, they will have to, liquidity providers, I would say, they would have to be compensated for bearing that kind of inventory risk themselves. Now, it's a function of inventory cost and information, private information about, you never know what's inside this, what the insiders in the company has, right? If you are the market maker of New York Stock Exchange or Korea Stock Exchange, you don't have the private information as a dealer, but they have it. So I don't know. I'm scared to bear this risk, right, of information. So for that part, they would have to widen the spread, okay? Bid-ask spread increases when there seems to be a lot more private information going on, as opposed to all the information is disclosed well and transparent, right? Bid-ask spread in transparent market, less transparent market. It goes back this way. And then it increases with FX exchange rate volatility. Volatility, of course, the price fluctuates. Like, imagine yourself working as a market maker of Bitcoin. How much of a bid-ask spread would you charge, right? As opposed to US dollar, Korean won kind of, dealer, right? Market maker. A lot more for this Bitcoin because there's a huge volatility going on. And then you never know what's going to happen to the price of this inventory that you carry. So that's why. And it decreases with dealer competition. More and more dealers compete against you. 박리담에, like you cut your profit or your compensation to be able to compete in this market maker position or dealer market. Okay, so private information is an important determinant of spot exchange rates. And then there is the next concept we're going to talk about is forward market in FX. And then we're going to learn briefly about the market conventions, forward rate quotations, long short positions, and something called non-deliverable forward contract, NDF we say it, and then forward cross exchange rates, which is pretty much the same as spot cross exchange rates, and then some concept called forward premium and discount, and then swap transaction basics, right? Now, forward rate quotation, well, forward market for FX involves agreements to buy and sell foreign currencies in the future at prices agreed upon today, okay? So not today's market, but 3 months down the road, or 1 month down the road, or 6 months, 1 year, X years down the road, okay? So 선도 거래 in Korean terminology, right? 선도 거래 is forward market, and then it's about, you know, hedging tools, right? Risk management tools, right? What if this FX price, US dollar price goes up, okay? In the future, I'm gonna take a long position, okay? If you expect the US dollar value going up, right, you will take a long position on that. If you anticipate depreciating US dollar value, you're gonna take the short position in forward market, okay? The time span, right? It could be anything, but there are some more common maturities that people refer to. That those are 1 month, 3 months, 6 months, 9 months, and 12 months. 369, 369, like every multiples of 3 months until 12 months, right? Plus 1 month, right? Anyway, are readily available for forward contracts, and then longer term swaps are also available. Now, consider the exchange rates shown to the right. For British pound, the spot exchange rate is, let's say, US dollar and then British pound exchange rate, okay? The rate is $1.44 per pound, while the 6 month, 180 days, right? 365 days divided by 2, isn't it 182.5 or something, right? There we use 360 days convention, and then half is like 180 days, right? And then forward rate is $1.4416 per pound. Okay, that's direct quote from US perspective. Now, what's up with that? Well, clearly market participants expect that the pound will be worth more. Pound will appreciate in 6 month terms, right? US dollars will depreciate, okay, over the 6 month horizon. So pound is in premium, and then dollars is in discount. Forward premium, forward discount. That's the idea. Now, based on that forward rate information, you can compute dollar-based holding period return, HPR, I say over here. Now, consider the dollar holding period return of a dollar-based investor, okay, who buys 1 million pound at the spot exchange rate today and sells them forward, okay, 6 months down the road, right? Half a year down the road, I have a contract. I make a contract that I'm going to sell it, okay, in those 1 million pounds worth of it today. So what's going to be my expected return, holding period return? As long as my holding period return associated with this forward contract, right? That is this guy. My forward contract based price, I have to sell it at this price anyway. And then today I purchased it. So right away I lock in this profit. Okay? That is 0.000971, which is 0.0972%, and that's half a year's profit. Okay, we want to annualize that number. Well, multiply it by 2. Okay, that's 0.14 1944%. So other way of saying it is 19 basis point or 19.44 basis points. So that's how we tell the numbers, read the numbers. Now forward premium, the concept, okay, is similar, right? Now the interest rate differential implied by forward premium or discount, this kind of concept will be discussed more in chapter 6, right? And for example, suppose the euro is appreciating from 1.13 to $1 per euro spot exchange rate to $1.13989 per euro in forward market, 6 months forward or 180 days forward. Okay, what's the premium? Well, you annualize that, right? So forward rate minus spot rate over spot rate. Forward minus spot over spot times the annualizing factor, which is 2 over here, right? So 1.13989 minus 1.1321 over the same thing times 2. That's 0.01211201. That's 1.2 percentage point premium, right? So that's how it works. Now the next, if you have agreed to sell anything, spot or forward, you are short. Okay. If you have agreed to buy anything in the future or spot, you are long, or a long short position. I guess by now you're familiar with this terminology because you have a lot of discussion about short sellers and then short positions and all these kind of things, right? Long, short. So if you have agreed to sell on FX forward, you are short. And if you have agreed to buy on FX forward, you are long, right? So depending on your positions, at the end of the maturity of forward contract, your payoff may be different. Okay, so what you see on the x-axis is the spot exchange in 6 months down the road. Okay, 6 months spot exchange rate, dollars per pound. Okay, what you have on your vertical axis is profit or loss, P&L, right? And then the red line shows the payoff from long position in when you take 10,000 pounds position. Okay, and then the light green line over here is payoff from short position in 10,000 pounds, right? Depending on the spot exchange rate 6 months down the road. Okay, you see that those two are 45 degrees line, either positive or negative, and then it crosses at the same point over here, 1.4416. That is the forward rate, 6 months forward rate, dollars per pound. You remember that table? So that's the intercept. Okay, and consider the payoff at maturity to a long position in a 6 months forward contract on 10,000 pounds purchased at 1.4416 pound. So as long as the spot rate hits over here, I'm break even. Okay, if it goes above 1.4416 and I'm in long position, okay, then I'm in the money, right? I'm making money, paying positive profit, right? Otherwise, I would be losing money over here. Okay, the red line, okay, loss or profit. Now, spot exchange rate in 6 months, dollars per pound, country US, right? Per pound, it looks like this, right? So that's the diagram how it works, right? For short position guys, you will make money if the spot exchange rate is lower than this guy, right? Long position, you make money if it is higher than this guy, because you take the long position and then you can sell it at higher exchange rate at that spot rate. Okay, so that's why. Anyway, yeah, like this 45 degrees line, you can utilize it and then do the numbers. And there is a market called the non-deliverable forward market. It's due to government-initiated capital controls, right? You cannot just freely take out the whole bunch of notional amount, right? Millions and billions of dollars of forward contract, and then you take the money out of that country or into that country. Not easy, okay? If you try to do it in any developing countries like China or other Myanmar or Vietnam, the government will come back to you. So you don't want to actually cause any delivery of the notional amount, but let's keep the principle, but just bet on the differences. So that's the non-deliverable forward contract. It's about the difference. You're taking the profit or loss and then giving the money or taking the money or giving the money as much as the difference is concerned, right? So that's the NDF market. For many of these currencies, trading in non-deliverable forward contract exists, and non-deliverable forward contract is settled in cash, usually in US dollars. Settlement is calculated by the differences between the forward price agreed to in the contract and the spot price at the maturity of the contract multiplied by the contract size, right? Now, having learned about forward markets, you may wonder, is there, cross exchange rate kind of things in forward market? Why not? Yes. Okay. So here's an example: forward cross rates between British pound and euro. Okay. So based on the currency table that you've seen before, right? Let's see. Let me take you back to 2016. Okay, numbers over here. You have 3 months forward rate between euro and US dollars. And then you have 3 months forward rate between British pound and US dollars, right? Based on these two numbers, you can compute euro to pound cross forward rate. Yeah. So $1.13 per euro times $1.4407 per pound exchange rate, but the reciprocal, because you want to calculate pound per euro price. Okay, so reciprocal of it. So you see 0.788 pound per euro in forward rate. And currency symbols, well, in addition to the familiar currency symbols, pound, yen, euro, and dollar, there are 3-letter codes for all currencies. It is a long list, but selected codes include Swiss franc, CHF. I don't know why that CH comes from. Schweizer, I don't know. And then GBP, Great British Pound, ZAR, that is South African Rand, and CAD, Canadian Dollar, and KRW, yes, you guessed it right, Korean Won, South Korean Won. JPY, Japanese Yen, it's not JYP, by the way, and SGD, that's Singaporean Dollar, right, Sing Dollar. Many things you will learn as you go down the road. A swap, a swap is an agreement to provide a counterparty with something he or she wants in exchange for something that you want, right? Often it's on a recurring basis. Every 6 months or 5 years, you swap those assets between you and me and then other counterparties, right? Swap transactions account for approximately 56% of interbank FX trading, whereas outright trades are 11%. Okay, swaps are covered fully in Chapter 14, so please wait for that. And there is something called exchange traded currency funds. Now, nowadays, you must be familiar with something called ETF, ARK investment, right? ARK. If you don't know about this, go ahead and Google search it. And Kathy Wood is there, right? ARK Investment. Is it ARK? ARK? Or Ouch Investment? I don't know. Okay? But anyway, ETF is kind of a mutual fund. Okay? That is already diversified in their portfolio, in their proclaimed asset allocation strategy or investment strategy. And then they can invest in all different kinds of stocks based on their investment ideas. For example, investing in tech stocks only. That's tech stock ETF. Right? Can you think about ETFs focused on the currencies? That's this guy, right? Exchange traded currency funds, right? You can go ahead and click this one and then see that this is individual shares are denominated in the US dollar and traded on the New York Stock Exchange. Let me pull out this guy, currency ETFs, right, that I clicked before. Yeah, there's a whole bunch of currency ETFs. You see it down here. Invesco, yes, and other companies are doing it, and then they're doing it in euro, and then other Canadian dollars and other things like that, right? So it's tracking those exchange rates over there, and then consider an ETF where each share represents 100 euros. The price of one share at any point in time will reflect the spot dollar value of 100 euros plus accumulated interest minus expenses. And then the 6 additional currency trust. I mean, why is it interest? Because once you convert that currency into the money into that currency, you will park your money, invest in money in their treasuries in their government or something. So the interest rate will will be given to you, and then there's a fund manager that is operating it for you, either machine or the traders. So the expenses incur. So that's why you minus it. Now 6 additional currency trusts exist in the Australian dollar, British pound, sterling, Canadian dollar. How many of them? It's not important because there is going to be a lot more coming up. Already in that website, you see a lot more. Okay, the currency is now recognized as a distinct asset class, one of the important commodities, right? Like stocks and bonds, currency ETFs facilitate investing in these currencies. Now, FICC, I told you before, FICC is a typical department in your investment banks that take care of foreign currencies, right? FX, risk management. Fixed income, FX, and then the derivatives related to this, together with commodities, right, and currencies. So that's that, right? Fixed income, commodities, and currencies. They are treated in one department. Anyway, the summary is self-evident, so just read it there, and then I hope you liked my lecture. So thanks for watching and see you in the next lecture. Bye.